Okay, so you've given us some really interesting stuff to dig into this week. Looks like we're focusing on the stock market and maybe even more importantly, where things could be headed in the next few months, right?
Yeah, absolutely. We've got a really timely market update here, so it's giving us a good snapshot of, recent performance and key trends. And alongside that, we have this really forward-looking analysis that tries to anticipate where the market might be going over the next 6 months.
Okay, cool.
Our goal today is to, really try to tease out the most important insights from all of this and help make sense of what feels like, kind of a crazy economic landscape right now.
Yeah, for sure. For sure. So just taking a quick look at the current situation in the S&P 500,
Hmm.
it did finally break that 4-week losing streak.
Right.
So at least we got a little breathing room there. But, it's still down significantly, like 7.8% below that February peak.
Hmm.
And the analysis you sent, it suggests that things might not be over yet. Like we could see more dips as we get into April.
Yeah.
So let's jump right in. It seems like the main themes here are, the potential for a real market downturn, the things that could actually trigger it, and then some ways to think about investing in this kind of environment.
Yeah, that's a really sharp overview. And you're right, the forward-looking analysis you sent, it really does spend a lot of time outlining what it sees as potential leading indicators of a much bigger stock market correction, or maybe
Interesting.
even a sharper decline, like you said.
Okay, so let's get into the details. What are the specific S&P 500 levels they're pointing to? Like, what should we be watching out for?
Well, they've highlighted three main levels to keep an eye on. The first one is 5,532 points. If the S&P falls to that point, we're talking about a 10% drop from its recent high, and that's usually the marker for a market correction. And then below that, they're looking at 5,317 points. This represents like the average historical market decline, which is about 13.5%. And then this is the level that really stands out, 5,000 points. If we drop to that level, that's a 19% decrease. And that could signal that we're moving into a bear market.
Wow, those are some serious numbers.
Hmm.
So what are the big factors that could push us towards those levels? It sounds like there are a lot of things kind of working together here.
Yeah, exactly. The market update really emphasizes these three critical factors that they think will have a huge impact on where the market goes in the near future: tariffs, inflation, and then the potential for cuts to the government budget.
Okay, let's break those down one by one, starting with tariffs. The update mentions that the Trump administration reimposed that 25% tax on steel and aluminum, right?
Hmm.
But there's a very important date attached to all of this, April 2nd.
Yeah, you got it. April 2nd is super important because that's when they expect those reciprocal tariffs to kick in. And the analysis, it suggests that this could have a ripple effect across a bunch of different industries. They even use Ford as an example. Ford's already saying that they expect this to impact their operations.
Okay, so how do these tariffs connect to inflation? Because it seems like the sources are suggesting a pretty direct link there.
Yeah, absolutely. The argument is that these tariff increases are going to directly raise the cost of production for companies. And then, of course, companies are going to pass those costs on to consumers as higher prices for, well, for everything. And that's basically inflation, right? The Peterson Institute, they're projecting that inflation could increase by like 4% to 7% this year. That's a lot, and that really highlights how big this impact could be.
Right.
Higher inflation means that consumers have less money to spend, and that can hurt company earnings, which makes investors nervous.
Yeah, makes total sense. Higher prices, less money to spend, and then lower profits spook investors. Okay, now the third factor here is the potential for budget cuts. Specifically, this proposed 20% reduction in the public sector.
Yeah.
That sounds like a massive change in government spending, and it could affect a lot of jobs.
Oh, absolutely. The analysis actually points out that a 20% cut could lead to something like 1 million jobs lost in the public sector. That's a huge number. And the impact on the economy could be pretty significant. We could see a contraction in public spending that affects like 25% of all economic activity. And, losing that many jobs, reducing government spending that much, it's definitely going to slow down economic growth and probably make the market even more volatile.
Okay, so we have all these potential downward pressures building. Tariffs potentially causing more inflation, a lot of public sector jobs potentially being lost, and government spending being reduced. So given all of this, what kind of investment strategies does the analysis recommend for the next 6 months? Like, how do we navigate this?
Well, they're recommending something called a barbell strategy. And basically what that means is you take about 50% of your portfolio and put it into technology and growth stocks.
Okay.
The idea is that these sectors, they might still offer some long-term growth opportunities, even if the overall economy is struggling.
Okay.
And then the other 50%, you put that into safer assets like money markets and
All
bonds.
right.
Money markets, those are basically really short-term, low-risk investments. And then bonds, those are loans to governments or corporations. They tend to be less volatile than stocks.
Makes sense.
And what's interesting about this approach, especially given what your sources are saying, is that it acknowledges that there's still potential for growth in certain areas of tech, even with all the economic uncertainty. But it also prepares you for the possibility that those headwinds, that they get stronger. Putting some money into safer assets, it's not just about avoiding losses. It also gives you some flexibility to buy more of those tech stocks if the market does go down like they're predicting.
So it was like a balancing act, trying to get some long-term gains while also protecting your money if things get rough.
Exactly.
Okay, so the sources also mention some specific investment opportunities within those broad categories, and they highlight some things to be careful about. Let's start with healthcare.
Sure. In healthcare, they specifically mention the XLV ETF.
Uh-huh.
That's like a basket of stocks that tracks how a whole bunch of different healthcare companies are doing. And they also mention Eli Lilly, the stock ticker LLY.
Got it. Now, what about on the tech side of that barbell? We saw some specific company names earlier: Supermicrocomputer, UiPath, and The Trade Desk. Is there any particular reason those were highlighted in the analysis?
That's a good question. They don't really dive deep into the individual picks, but I think the implication is that these companies represent areas where you could see strong growth, even if the broader economy isn't doing so well. Supermicrocomputer, they're involved in high-performance computing, which is a growing field. UiPath is all about automation software, which is becoming more and more important for businesses. And then the Trade Desk, they're in advertising technology, and that sector's likely to see continued demand no matter what the market's doing.
That's really helpful context.
Yeah.
And what about on the other side of the barbell, the safer assets? You mentioned bonds and money markets.
Right. They bring up the traditional role of U.S. Treasury bonds, which are currently yielding about 4.3%, and then money market funds. They're both good options for stability in uncertain times.
That makes sense. But the update also mentions something called worthy bonds. This seems a little different from your typical low-yield government bonds.
Yeah, it is. What's cool here is that they're talking about options beyond the usual low-yield bonds. Worthy bonds, they offer a much higher yield, around 7%. Which is, pretty attractive compared to what you get with treasuries right now. And these bonds are backed by loans to small businesses and short-term real estate projects.
Okay.
They also point out that you can invest with just $10, and there are no fees for withdrawing your money, so it's something that could be really appealing to a lot of investors who are looking for higher fixed income in this kind of environment.
Yeah, definitely something to consider as part of that safer allocation. Potentially higher returns, but it's important to remember that investing in something backed by small businesses and real estate, that might have a different risk profile than government bonds.
Right.
Okay, so to kind of tie all this together, the analysis highlights some specific dates that could be really important for the market.
Yeah, definitely. It's going to be crucial to keep a close eye on these dates. The first one, as we already discussed, is April 2nd, when those reciprocal tariffs are expected to take effect. We'll have to see how the market reacts immediately and also what kind of statements we hear from the industries that are affected.
And then just a couple days later, April 4th, what's happening then?
So on April 4th, we get the non-farm payroll report. And the analysis points out that this is going to be the first real indication of how those potential government job losses are actually playing out. If the jobs report is weaker than expected, that could really amplify those concerns about the economic impact of the budget cuts.
Okay, got it. And then finally, there's April 11th. What's going on around then?
April 11th is when we start getting those earnings reports from the big banks, and those are always important, but in this current environment, they're going to be even more so because they can give us a good sense of how healthy the economy is overall, and specifically how the financial sector is doing, and that can really influence how the entire market feels.
Okay, so to recap, it sounds like the picture painted by your sources is one of a lot of uncertainty in the stock market.
Yeah.
We're seeing a little bit of a recovery after those recent drops, but there are still some major challenges coming up. Tariffs that could lead to even higher inflation, the possibility of big budget cuts and job losses in the government, and then all those important economic reports and company earnings coming out in early April that could really set the tone for the next few weeks and months. Okay, so that sets the stage. So let's search some.
Yeah, no, that's a really clear and accurate summary. I think your sources are right to emphasize that investors need to be strategic and informed right now. Don't just react emotionally to every little market swing.
Yeah, that makes sense.
Yeah.
And the strategy they're suggesting is that barbell approach, right? Finding a balance between the potential for long-term growth in technology and the relative safety of things like bonds and money markets, and even considering other options like worthy bonds. Basically, you're trying to protect your money while also being ready to take advantage of buying opportunities if the market does go down further. And of course, we need to keep a close eye on those important dates in April.
Absolutely. Tracking those indicators is going to give you a much better idea of whether the things that these sources are worried about are actually happening and how the market is reacting to them.
Okay, so here's a final thought for everyone listening. Given all this talk of potential risks and opportunities, how do you think different investors with different levels of risk tolerance and different investment goals should be interpreting all of this information? What kind of additional research into specific sectors, individual companies, or even things like worthy bonds would be helpful for you, given your own financial situation and your goals? There's a lot to consider here, but hopefully this deep dive has given you some valuable insights into the key factors that are at play. Thanks for exploring this with us,
My pleasure.
and we'll see you next time.
See you then.
The Smart Investor Podcast is your ally in making informed financial decisions and building a prosperous future. Each episode brings you concrete strategies, expert advice, and opportunities to maximize your investments. Don't wait any longer to transform your mindset and boost your financial freedom. Subscribe now and join a community of ambitious investors ready to take action. The Smart Investor Podcast est votre allié pour prendre des décisions financières éclairées et bâtir un avenir prospère. Chaque épisode vous apporte des stratégies concrètes, des conseils d'experts et des opportunités pour maximiser vos investissements. N'attendez plus pour transformer votre mindset et booster votre liberté financière. Abonnez-vous dès maintenant et rejoignez une communauté d'investisseurs ambitieux, prêts à passer à l'action. The Smart Investor Podcast is your ally in making informed financial decisions and building a prosperous future. Each episode brings you concrete strategies, expert advice, and opportunities to maximize your investments. Don't wait any longer to transform your mindset and boost your financial freedom. Subscribe now and join a community of ambitious investors ready to take action.